Hello, thank you for joining us for part 4 of this special training series collaboration between the National Good Food Network and Farm Credit. My name is Will Gray from the Wallace Center at Winrock International. This special series is designed for food hubs and related businesses to take control of their finances using accurate, industry-standard practices. When you put these lessons to work, you'll be better informed, make better decisions, and make your food business that much more successful and impactful. In part 4 of our 5-part series, our noble leaders Aaron Pirro and Gary Madison will lead us through the statement of cash flows. It may sound obvious, but lack of cash is one of the biggest reasons businesses fail, and that's especially true for small businesses, seasonal businesses, and startups. Knowing what's coming in, what's flowing out, and when is critical in planning for growth and the future. Now, I'm going to let Gary and Aaron jump right in. If you'd like to hear their bio and a little more about them, then you got to go back to the first part of the series and listen to that recording. But for right now, I'm going to say, take it away, guys.
All right. Thank you, Will.
All right. So today we're the topic of this is this statement of cash flows. It'll get a little bit more complicated than some of the other webinars that we've done. But I want to start out by going over the 3 main reports that we're talking about in this series: balance sheet, income statement, and statement of cash flows. And as a way to picture how these are used, we'd like you to think of the balance sheet, which we've already described as a snapshot, a picture at a point in time. The income statement as a movie, and by way of extending the analogy, the statement of cash flows that we're going to be talking about today is really the synopsis that tells you all of the plot twists. It doesn't leave stuff out as far as the major incidents that happen in the plot, but it leaves out some of the connecting tissue maybe that the income statement would tell you every time. And remember that the balance sheet is going to tell you assets and liabilities and equity, or your net worth, and that would be assets being the things you own, liabilities what you owe, and equity being net worth, what is your investment, your portion of ownership in the business. The income statement or profit and loss statement is going to show you expenses and divided between cost of goods sold and overhead, and also show you gross margin and profit. That's where the long version of the movie is a series of income statements that you're going to be should be able to pull out of your computer at any given moment to tell you what's going on. And the statement of cash flows, again, is what we're talking about today, and that's going to give us a quick way to see what's going on with the cash that's moving in and out of the business. So let's do a little bit of further explanation about the purpose of the cash flow statement. And of course, it seems obvious. It's going to track the flow of money in and out, but it's also going to follow the things that aren't always an income and expense. And I'll give you an example of that in a minute. But it also shows how the balance sheet changes are affecting cash. And that's important, as we'll see in another couple of slides, for things like capital expenses. And probably most importantly, the cash flow statement gives a record of what's happened. You're going to end up doing some complicated things in your business that are, not exactly a food hub business. For instance, you may think you're a food hub, but if you're going to allow customers to have credit, to delay paying you, to have, in other words, accounts receivable, you've just entered the banking business. You are extending credit. So you may think you're in the food hub business, but something as simple as extending credit to somebody sort of puts you in a different place. And as soon as you have accounts receivable, you've got a problem as far as recording what's going on in your business, that a statement of cash flows is designed to help you understand both the magnitude and the extent and the timing of of those problems that you've created yourself by doing really normal business practices like extending credit. So, some key things to know. You are not creating any new specific accounts in order to have or generate and utilize a cash flow statement. Aaron, can you click to the next slide? There we go. So nothing new is being created here. You're taking the same information that you already have and you're showing it in a different way for the different purposes that we just talked about on the previous slide. Now, the idea of showing the sources and the uses of cash, if a source is something like, let's say you collected accounts receivable, so it's a positive, it's a good thing for you. You got paid the accounts receivable money. A use in the other direction is negative, and an example of that would be you paid down your accounts payable. So those are showing exactly when that happens and where the source of money is coming from is extremely important to know how much cash you have on hand. You may think you can do this by looking in your checkbook, but of course your checkbook doesn't tell you if you've made a profit. And I'd also say that trying to manage from your checkbook is very seductive. You know, you look at the checkbook balance, the numbers in one place, you can look it up online from your bank, and it always works right up to the point until it doesn't, because your checkbook is not telling you all of the information that you need to know, particularly something that is as common as having accounts payable or accounts receivable. So, lastly, as far as a tool of forecasting, you can forecast your cash flow statement. It's very similar to forecasting a profit and loss statement or the balance sheet. Forecasting all of the cash that goes in and out for a year for a small business is a little bit more complicated, and that's really more of a budgeting function. What we're going to be talking about today will be just the facts, not really forecasting. Where's the money? Where did it come from? And where did it go?
So when we start to look at the statement of cash flows, we'll notice it's broken down into three parts. The first one summarizes the effect of operations on cash. So through your normal daily operations of the sales, paying bills, collecting receipts, running up bills, and so forth, how does that all add up to impact the checkbook? The second part will be the effect of investments. What have you spent money on? Plant, property, equipment, things like that. And what have you brought in for income related to those? Have you sold any equipment? That'll show up in this section. And finally, there'll be the financing part, which is what summarizes any money borrowed, money repaid, or any contributions or draws made. And that's really covering the equity of the company, how that's changing aside from earnings. And those are important because on this grand scale, if you get to look at your business and figure out which of these is creating the most cash for my business and which of these is using up the most cash for my business, you're going to manage very differently. So that's why it's important to get a good handle on where the money's coming from and where it's going. You can look at this in the most basic level on the annual basis, right? So just run this report for an entire year and see where the money came from and where it went. But as you get further down into the weeds and have a better handle on the report, it can be useful to look at it monthly. That way you see the effect of a shorter term period. And I know some folks that even like to go weekly once they really understand it, because then that helps in the forecasting. Understanding the week-to-week movement or the month-to-month movement gets a good handle on setting expectations for the future years. So let's dig into these. First, we'll look at operations. It's going to start on the indirect basis with net accrual income. So remember those adjustments we talked about last time? Here, we're going to see what accrual income is, and then we're going to look at changes in accounts receivable, supplies, inventory, and prepaid. So if you put money into these things or they go up on your balance sheet, those are going to be uses of cash. If you collect them or use them up, they would be sources of cash. Then look at accounts payable and accrued expenses, and those, if you pay them down, will be uses of cash. If you run them up, will be sources of cash because you haven't had to pay for them yet. And finally, depreciation does matter because while there is some physical depreciation no matter what, the amount you get to write off on your income taxes or have in your accounting software isn't something that you actually write a check for. So therefore, you can use that as a source for other activities. And that's where people get into trouble when you hear the expression living off of depreciation, right? That means you're not really earmarking that money for something of a replacement value, but you're taking that depreciation and shoveling that money towards something else, which means you're not really preparing for the future. So that's what that means. Now, as we get into the second section, we're going to talk about financing. And this is, again, anything you're borrowing and repaying. It's important to notice the activity on lines of credit because we may have an annual paydown schedule, but if we run up a high balance on it and then haven't had the chance to pay it down or are going to find it difficult paying down, that's a good thing to know ahead of time what that balance is. We're also going to look at contributions from members and if those members are taking any draws. That's also going to impact this section. And that's important to know because if you're doing a great job in business, or so you think, yet you're having to put in a lot of money, chances are those operations aren't yielding as much cash as you thought, and that's what's driving the need for the contribution. Once you know that, you can do something about it because the goal is to have a sustainable business which is self-sufficient and not requiring you to keep contributing from savings. Gary, are you still with us?
Oh, I am. I'm sorry I was on mute, Aaron. All right, that solves that problem. If you have an example of this in your statement of cash flows is to look at a capital purchase. And it's important to break transactions into pieces so that you know you can record things better. So in this example, I'm going to take my existing $25,000 truck and sell it to a truck dealer, and I'm going to buy a $35,000. I'm going to buy a truck for $35,000. So you may think I've just spent $10,000 on a truck, but actually I've done several things, and this goes back to that idea of you may think you're in the food hub business, but all of a sudden now you're in the trucking business or the truck purchasing business, and actually the truck selling business, because the first thing you did was to sell a $25,000 truck, and then you're going to purchase a $35,000 truck, and you may even finance some of that $35,000. So there's a potential third part of this transaction that you have to get recorded and do it accurately and do it right the first time so that you don't forget what happened several years from now, or several months from now, because if we're talking $35,000 and yeah, gosh, I traded in the truck and what was that worth, and I forget how much we financed, or if you enter these separate transactions correctly the first time, you have for a statement of cash flows, you know exactly where the money came from, and you can make sure that you can go back and recreate the chain of events in the future if you need to do that. If you were just looking at, go ahead, Erin.
It's also a really important communication tool, because if you're trying to explain to your board of directors or board of advisors that you need $35,000 for a vehicle purchase, right, that's going to be a very different picture than in the past if you've always only had $10,000 purchases because you've been trading in. Right, so it's about communicating clearly and setting the right expectation about what these things cost and how often you need to do them. All right, so if we're going to put it all together, you have two choices of the type of cash flow statement that you work with. The direct one starts with cash receipts and adds cash paid for the major items to get the net cash for operations, which is very much like a cash basis income statement. So that's you seeing money in and money out, but it doesn't really incorporate those other pieces that Gary talked about earlier, such as when you inadvertently get into the banking business. The indirect version, which is the one that pretty much all companies use and the accounting software is built off of, it starts with net accrual income. Remember all those adjustments we did last time? That's where we're going to get to. Then it adds the sources and subtracts the uses from operations. So again, if I pay down a bunch of accounts payable, that's going to be a use of cash that maybe doesn't show up on my accrual income statement because I incurred those expenses earlier and therefore had them in my management records in the time period they were incurred. And that helps us get us to net cash from operations. Now here's an example of the indirect. We start with accrual income in this example of $20,000. We look at the changes in a few of these items. Remember there's 7 altogether. I wanted to make sure that's fit on the screen. And we look at accounts receivable growing by $50,000. Now why is that negative? That's negative because it's a use of cash for you because you didn't collect it. You had to put the money into creating the items or paying the labor for the service that you provide, which costs you money and therefore is a use of cash. So until you collect it, it's going to sit on the statement of cash flows showing that it's a use. Now, if you use some of the prepaid expenses or use some trade credit for accounts payable, that's going to help provide a source of cash to offset that. And then when we add in the effective depreciation, again, something we didn't actually write a check for, we see that cash from operating activities was actually negative $32,000, or meaning despite all the great business we did, we had to put $32,000 into doing that work. The next section, the purchase of equipment, we know that cost us $20,000. And then finally, we have the financing activities, which sums up that we borrowed $15,000 during the course of this time period. We repaid $2,000. We had to put in $30,000 of contributions to make this happen, and we took a draw of $1,000. So the financing activities really are what contributed the most cash to keep this business going. And if we add all those activities to the beginning net accrual income, we see where we end up with our ending cash. So we didn't collect everything that we thought we were going to, and we need to make sure that we account for that. And why this is such a great report to look at is that all of that growth, those additional sales, actually made a use of a lot of cash, which maybe we weren't planning on. Our investing activities also took a lot of cash, and that meant we need to borrow that in order to keep going through our business operations. So once we know that, now we can make some good management decisions about what we want to do going forward. Maybe we don't extend as much credit to our customers in the future because we need that cash in order to grow. Just puts it in a little different perspective so that we can plan for a sustainable growth that isn't as stressful. Now the direct method is going to start with cash flows from operating activities. Look at our cash receipts, look at what we pay out, and then you'll notice the investing activities and financing activities aren't very different, but they get us to the same place of a net change in cash. And the reason most companies use the other method, the indirect method, is because they are tracking on an accrual basis their earnings. And hopefully through the past couple of webinars, we have encouraged you to think in that direction in terms of management information and really matching your income and expenses in the same time period, as opposed to just recording when cash comes in and when cash goes out.
All right, so let's try to sum it up just for a moment here. The statement of cash flows is important so you can take transactions that some of which is going to appear on a balance sheet, some of which is going to be in an income statement, and put it together in one place so you can track it. So as your business work to do in advance of the office hours we'll be having on Thursday is to print out your statement of cash flows and determine if it's direct or indirect, according to what Aaron was just describing as far as whether you're using accrual accounting or not. And try to see if you can find out what the biggest driver of difference was between what was in your checkbook at the beginning of the month and then at the end of the month. Was it from operations or financing or investing? If you can answer all of these questions in an email and send it to me at madison@fccouncil.com before, there's my email address, thank you. You can send that to me by 8 a.m. on Thursday. You will be entered into a drawing for that very nice Farm Credit hat and a chicken USB drive. That's for storing data in general. It's not for storing chickens. I want to point that out. So with that, Will, that's all Aaron and I had to say. Let's see if there's time for some questions.
Awesome. Thanks, guys. Big thanks to Aaron and Gary for that presentation. And yeah, we do have a couple minutes left. So we got a couple questions, and folks, please feel free to send in some more. This first one is a question about sort of relative importance. So of the three sources of cash, when you're looking at operating, investing, and financing, which is the most important to track, or are they all, or maybe what does tracking each of them tell you about your business?
Oh, great question. They're all important because they all are part of the business that you're running. Now, in some time periods, you might not be investing, as in you go through the first 6 months of the year or this year and have a zero capital budget. So you may not be purchasing anything, and therefore there'll be nothing to record in that section. But really, you're in business in operations. So that's the one that I think can be the most enlightening to managers to be looking at. Where is the cash going because of my activities, and where is it coming from? Certainly if there's a shortfall, that's where the financing activities will show up. And eventually you'll get to the point where, fingers crossed, this is a good goal, you could be the one lending money, whether it's to another food hub or another startup business. And that would actually show up in that section as well. But for the prime reason that you are in business, to make money, whether you're a for-profit or not-for-profit on a tax basis, you need to be in business to make money. And that is why it's so important to focus really on those operating activities. Because even if you're making money on an accrual basis, you need to know, oh, am I getting paid for this on time? And then I have enough cash to then further the growth that I'm planning for the coming year.
Great, thank you. And I've got another question here that I think is somewhat related, but I put this slide back up just so that we could look at the numbers themselves and ask, so is it okay that some of those flows are negative and others are positive? And when is it okay, or why is it okay if something's going up and something's going down?
Oh, really good question. I think it reminds me back to one of my early trainings, which said you don't have to have a perfect business. You need to perfectly understand the business that you have. So there are reasons that it would be negative. For instance, in this case, if you had to extend that credit, those accounts receivable, and allow the customer to pay you later in order to get that sale, that might be perfectly okay, unless it's 6 months down the road and now you're really starting to question whether or not you're going to get paid. Investing activities, if you are able to put money into replacing plant and equipment over time, that's an important sign that your business is doing well because you're able to do that. If you need to finance it in order to make that happen, that's perfectly reasonable because you're trading off time and some interest in order to use that piece of equipment early on. It's when you end up financing more than what you're investing, or almost all of it, that can be a sign of trouble in a business. We also have to look at what is really being financed here. So in this case, if the purchase of equipment was $20,000 and we borrowed 15 of it, we're still putting 25% down. That's a good sign. And the money repaid on that loan, $2,000, means we're making progress along the way too, which is fantastic. The part that's not so pleasant is that I had to take $30,000 out of my savings to put in and help cover the fact that I let customers not pay us right away because I still had to make payroll in that time period. And that's where, from a management standpoint, you have to decide, do you want the business to be providing that cash and therefore putting it in itself, meaning collect those receivables or only do cash and carry? Or am I okay using savings from outside the business or some other source in order to get through those lean periods? Will I be paying that back later and drawing it back out, or is that going to be in there as permanent working capital? That's also going to factor into that decision.
I'd add to that, Erin, that in a business like farming or even a food hub business that is seasonal, the danger that having a good statement of cash flows helps you see is when you're starting out your season and you say, I know I'm going to have to put money into the business at this point because we don't have that much in sales, so you end up borrowing money or using member contributions to fund operations, and you keep telling yourself, well, this will only happen for a little while because I know we make money later in the year. That's a dangerous sort of mindset to get into if you don't have that budgeted out, and your statement of cash flows tells you how much of that you're doing. A seasonal-based business, again, like farming or most food hubs, is going to be at risk for that kind of management behavior.
Mm-hmm.
And one more question here that I think you guys just got very close to, which is, what is the period that makes most sense to look at when you're looking at a statement of cash flows? It seems like it's likely more frequent than annual, but monthly might be too narrow to see trends over time.
I think really it needs to match up with whatever reporting period you're giving or you're presenting with those other two reports, because this is the companion report to the income statement. So if you're providing monthly reports for your audience, then you should have the monthly cash flow statement covering the same time period, because remember, it's supplemental information that you're not going to see on the profit and loss. This purchase of equipment isn't an expense. Granted, it might be either in the form of depreciation over time, or your accountant might Section 179 it. It's still a capital purchase, and then the decision is made over how quickly to depreciate it and therefore reflect an expense on the income statement. So bottom line is they've got to match up. The annual, if it company's annual reports, makes a whole lot of sense because then it shows you what happened in the broad spectrum of the entire year. But if you're looking at smaller periods, while you may not see trends, you may see them accumulating if you start to see, ooh, January operations took a lot of cash, February operations took a lot of cash, and March operations also took a lot of cash. Now we've really got to get on top of how are we going to replenish that cash? Where are we going to get it back out of the business?
Great, thank you. Now, I'm going to say for other questions, please, folks, let's keep them until let's save them for office hours, and feel free to email them along to us if you don't think that you're going to be able to join us.